A real estate investor's job, in my opinion, is to have credit so that he can pull the trigger and have liquidity so he can pull the trigger. Because unlike Christmas, Easter, Thanksgiving, and your birthday, Paul, deals are not cyclical. They do not, arrive at a certain time. They pop up when you least expect it. And if
Mhm.
you are not liquid and you do not have pre-approval with a lender like Corridor Funding or somebody else, you're shooting yourself in the foot because if you miss a deal, I'm sorry, you lost, you failed. If you are a real estate investor, your job is to buy right. And if you did not have the liquidity and the credit with somebody like us, you lost money.
Hey, welcome listeners. Today I have the distinct honor and privilege of having Jasen Miller on the show today as a guest. Jasen is a managing partner and co-founder to Corridor Funding based out of Texas. Jasen and I are great friends. We go way back. Our families are tight and just been looking forward to having this interview, this conversation for quite some time. So Jasen, welcome to the show today.
Hey, thank you, Paul. I have thoroughly enjoyed all of your podcast. I mean, you do a dynamite job. You've got some amazing guests. I have literally been very inspired from every guest that you've had. So I commend you on that. Thank you for putting that content out there. I share it with a lot of young men that I mentor and employees. And so, hey, I appreciate you doing this, and thanks for having me on.
Yeah, well, absolutely, Jasen. Well, thank you for the kind words, and you're certainly in the top of the stack of my guests. So we're going to keep that trend rolling of top people here today. Um, so do this right now. You own a very successful lending company based out of Texas, and we'll get into that in a minute. But tell our entrepreneurs, our listeners. Um, How'd you get started? Where did you come from? I mean, did you just wake up one day and jump into I'm going to start this lending company and be super successful, or was there a journey along the way?
So there was a journey, Paul. As you know, I used to be a land developer. We used to do 1,000 lot to 2,000 lot subdivisions, build golf courses, and put in the roads, and then we would sell the lots on a retail basis. And I did that until about 2010, um, and I wound down that company because the market was just different. People were not just actively buying lots as they had for most of my professional career. And I got into the oil and gas business. I had a couple oil and gas service companies that service the Eagle Ford Shale and the Permian Basin, which are two hotspots here in Texas for oil and natural gas. And what I learned, Paul, in that business is one, the money was good, but it was 24/7, 365, Christmas, birthdays, whatever the case. If there's a problem and an oil well is not producing at its optimal level, I've got to get one of my employees out there, or I had to go it's usually a 3 hour drive and get it fixed. And I enjoyed it, but the reality is, oil is a commodity,
Mm,
and rather, someone's working on one oil pipeline, and let's say, unfortunately, they lose their life because something happens, and then there's another pipeline where everything's going smoothly. The oil still comes out at the same price. Nobody cares if somebody passed away or how
mm,
difficult it was to get to market. It is a commodity product. And after coaching an employee through fixing a oil well down in the Eagle Ford Shale, I was at my parents' house in Dallas and I watched my mother set the table for Thanksgiving. Then I saw everybody sitting at the table waiting for me, and I'm still on the phone. Make a
mm.
long story short, I watch them eat dinner, have their coffee, dessert, and then go in to watch football, and I'm still on the phone. So that was the day that I knew that I would be selling those companies and getting into something else.
Wow, what a story. So when you made that decision, um, you were obviously doing well, but it was one of these situations where the business, it sounded like, really ran your life. So you're a highly paid, maybe not an entrepreneur, but a business owner, still trading all your time for dollars, right?
Very much so, very much so. I mean, it was relationship based at the top level, and that's how I've always liked to compete. I've never wanted to be a commodity. I have wanted to add value to every transaction I ever do. So it was enjoyable. I had some great employees. I whether it's a fault or a good thing, I don't know, but I Paul tend to grow very close to my employees, their children, their wives, and almost look at them now that I'm 52, kind of as a second child, if you will. So I'm still friends with a lot of the guys that had worked for me out in the oil field, but I'm happy to be here. And it's interesting how I got here. Right as the well, while I was running these companies, one of the companies that used to finance one of my developments had been calling me, 2 or 3 times a year, encouraging me to consider um, the business that I'm currently in, which is real estate investment lending, primarily in the single family residence space,
Hmm.
but also multifamily. That's what our specialties are. We can do other things, but we are very efficient at that, very good at that, and I have expertise in house. Actually, all of my loan originators have investment experience, so we have the ability to add value, and that's what we are seeking to do. But to get back to your question, it was one of my financiers that had been twisting my arm, telling me to, encouraging me to consider this. And my partner, I have a co-founder, Jasen Miller. He's my equal partner, great guy, very blessed to have met him. But he was also in the oil and gas business, and not enjoying the long days, long hours, and 24/7 production of oil. And when I shared this opportunity with him, he's like, let's do it. Because he came from a multifamily and single family
Wow.
investment, just kind of on the side. And I'm
Hmm.
like, Jason, who in the world would borrow, for 12%? Because I was a developer, I was borrowing at 5 and 6% from banks, and I just did not get it. But he kind of showed me, hey, had I ever known that was available, I would have been using this product. I had no idea there was something like that available. So Jason twisted my arm, and probably because I trusted him and I liked him, and I knew he was a hard worker. He's a very bright guy. We uh, we formed our company in March of 2016, and we were advised by my finance company that they would kind of coach us on how to get started, but that didn't happen. So we, like the blind, just kind of felt our way around. And the first thing I learned, Paul, is that at that time in 2016, when we were going to what are called RIAs, which are Real Estate Investment Association meetings, I would visit with people, and they would tell me about a hard loan. Uh, Back then, everybody called us hard money. I like to call us real estate investment lenders. But anyway, I'm losing that battle. We're still hard money. But I would hear these horror stories, Paul, about them getting quoted one, loan to cost, getting quoted one origination fee, getting quoted one interest payment. But when they actually showed up to closing, the leverage was lower, the rate was higher, the origination fee was higher, and there were a ton of junk fees in there.
Mm,
And Jason and I were like, wow, I've never done business that way. And this is going to be easy because we're going to be transparent, honest, and
mm,
not surprise people and take advantage of people when they're at the closing table. And if they don't close, they're going to lose their money's hard by that point. They're going to lose some money. So
mm,
that is how we came to market. Didn't spend a lot of money. We went to a lot of RIAs, spoke to a lot of groups, and people gave us a chance. And the the best asset we had, Paul, was referrals. People referred us to their friends. And, these are even competitors of theirs because they're all looking for off market deals. But they thought enough about us to refer us. And I would say after about 18 months, we were finally able to start eating things besides ramen noodles and spending money on marketing, and hired my first employee in 2017, and business has just been growing since then. We lend in almost all the states. My core states are 7 states, which are Texas. We do all the primary markets, secondary, tertiary here in Texas. We do a lot of markets in Florida. I do tend to avoid South Florida,
mm,
just because it's a very different market, and I feel like there's people I can refer business to that understand that market better. But we're all over the Panhandle, Orlando, Tampa, uh, Jacksonville. We're in Georgia, Tennessee, North Carolina, South Carolina, uh, Kansas, Missouri. So those are kind of our core states. I don't think I left anything out, but again, we can lend anywhere. Um, I think Paul, that over 86% of our business are repeat borrowers. So what usually leads me to doing a deal outside of one of my core competency states is that my investor has resources, knowledge, and an understanding of that market. And by that time, I have enough operational history to know that, hey, they're competent. They're not going to pursue something that they don't understand. And that's when we would endeavor to a state where I don't feel that I really understand the market, um, if that makes sense.
Yeah, yeah. So just a couple of lot to unpack here. So really the move into this space for you in 2016 was a little bit of a, I won't say an accident, but you were searching for something new, and then you had your relationships for over the years. You've been in the real estate development. You've been in and around the space for a long time, and then you got a nudge in the right direction when you're looking to get out of oil or gas, and um, by going out there and just living your core values of being transparent and honest, and trying to walk with integrity and building long-term relationships, that's where the business really started from. And I mean, so you seem like you were really shocked that the hard money world would leave people at the altar like that and treat them terribly, you know. And I know you personally, I know that's not how you operate, and that's how you got. It's kind of cool that that's how you got your genesis, and then the momentum just kind of built from there over and over again as you got more transactional experience with people.
That very well summarized, Paul. Very well summarized. And not treating people in an unethical manner, which I just wouldn't do anyway. But the benefit from a business standpoint is you get repeat borrowers, and that's what I value. When somebody calls, I've trained my staff, and I certainly say this: look, if I had a crystal ball and I knew we were just going to do one deal, I would refer you to a friendly competitor. We are looking for long-term partners. We want to be your reliable sidearm that you can pull and it will fire when you're making offers and trying to secure deals. We can compete with those cash offers. We're quick, and you building operational history with me only helps me help you more.
Mm-hmm. No, that's amazing, and to even to get a Texas-ism out of that, you have a reliable sidearm that fires when you need it. I'm just picturing being out on the wild west there in Texas in the oil field, and and there's a varmint coming around the corner, and you want to make
Yes,
sure.
yes. Well, we did see plenty of rattlesnakes, but I think that comes from my military days. Just knowing that you have a reliable, well oiled sidearm that will pop when you pull the trigger.
Yeah, yeah, and you did spend some time in the Air Force, right?
I did. 17 years.
Wow, wow. Well,
Most of it
thank you for
as
your time.
reservist, except for when I was activated after 9/11 and things like that. But yeah, I loved it. Had a blast.
Yeah, well, thanks for your service. That's amazing. So let's circle back a little bit to this idea that it was a new world that you came into, and you guys focus right now is you're trying to get away from the term hard money, but alternative lending for real estate investors maybe would be a good one. What is the argument for 12% interest rate? I mean, why if I'm like, okay, I'm trying to get it in the space, and I hear I can go get a mortgage on my house for, well, today 6.5% or some number, am I going to have shock at 12%? I mean, why should I pay that much? What's Educate me a little bit.
Yes. So if you look at the numbers, Paul, and you really study the transaction, and if you're using it correctly, it is a no-brainer. When I get people that want to negotiate over a point, my response to them is, look, as a real estate investor, you're a smart. I always do this to, you know, anyway, how I phrase it is, you're obviously a smart man. So as you know, money is made in real estate when you buy. You taking my time and your time to argue over one point is probably not in the best use of your time. I would encourage you to be out there looking, uh, making offers with our pre-approval letter, because as you know, investor, wholesalers frequently tie up properties with distressed sellers, and those distressed sellers really need that property to sell. And we have done several surveys with our active operators over the years, and every time, Paul, they convey that they win deals with that pre-approval letter and not even being the highest offer, because those distressed sellers need to know they're going to get out of that mortgage and the taxes. Either they've got a job to get to in another place, or maybe more unfortunately they just cannot afford it. So when they're left at the altar by a wholesaler that could not assign that deal, it puts them in a worse place. So that's what I'm encouraging my investors to focus on. You know, if 1% is going to kill your deal, you probably don't need to do it. And we are not, will not ever be the cheapest. Um, that's a promise. Don't try to be. We are competitive, very competitive, but I do not want me or my team to be so busy that we cannot be adding value to our clients. Because
Mhm.
what we do, Paul, which is a little unique, we set our KPIs based on what our clients' goals are, whether that's a certain profit from fix and flip
Mhm.
or building passive income, what we call a rental income empire. And that tends to be kind of the migration since 16 and 17, everybody was fix and flip. And then a lot of our people were saying, wow, I'm paying a lot of taxes. And we started educating them on a loan that we have that allows you to acquire a lot of rental incomes. I call it a landlord loan, but it's technically called a DSCR loan, and I'm sure you're familiar with that formula. But what this does, Paul, is it allows us to underwrite the property for its income, the income that it will produce based on the rental comps, right? So I've got a young man, 28, 29. He works for the government down in Corpus Christi, and he owns 22 homes,
Mm.
but he W-2 72,
Mm.
72K.
Wow.
You could never do that with a bank. Never
Right.
do that with a
Right.
bank. So I'm proud of that young man. I root him on. You know, we have calls from November to December with our clients to understand what are their goals for the following year. We document that, and then if they want to procure 3 deals a month, we are reminding them they need to make 8 to 12 offers per
Mm.
month
Yeah.
to meet that objective, right?
Right.
So that is how we try to add value. That's why um, and that's rewarding to me.
Mhm.
As I think I've shared with you before, Paul, I do not want to be in a business ever if it's not a win-win-win situation. And in our place, it's a win for the investor. They're finding something that they can add value. Back to your why 12%. If they're buying it right and they're adding value at 12%, and they're in it for 6 months, that interest is almost free,
Mhm.
because if they're building $50,000 equity and then they're able to finance out into our landlord loan, which is a 30-year fixed loan, um, it's just a home run for them. It's a
Right.
home run for them.
So that yeah, they've got the short answer is what you said here is you make your money when you buy. So they're if they buy it right, a point here, a point there is irrelevant. But what's more important is the fact that you're more of a you're the funding partner. You're behind them. You know what their goals are. You're there. You're going to deliver so that they can take that offer, turn it into a contract, buy it right, do whatever value add they need to do to the property to bring the equity base up, and then either flip it to a landlord loan to hold for long term at a much lower interest rate, I'm sure, than 12%,
Absolutely, yes.
or turn around and sell it and realize a capital gain if that's their model on some of them.
That's exactly right, Paul. And just to elaborate on that a bit, you know, as prices go up, of course, we're not maybe in that environment right now, but we were for several years. Equity builds, and they'll do a cash out on that property just to deploy in other rentals. And that's the young man that I'm speaking of. That was pretty much his entire strategy. He bought so well that he had equity when he refied into our 30-year landlord loan, and he's just been continually able to borrow equity, plus with what he saves from his job and the cash flow that he's now getting, he's just continuing to grow that portfolio. So
Right,
very, very
right.
proud of him. He's going to end up with a military retirement and then a very nice passive income retirement.
Yeah, a la Robert Kiyosaki, right? He's getting into that passive investor role and building it over time, and you guys are facilitating that. Well, tell us this. What are you seeing? I know the world shook a little bit through COVID. It was kind of weird in the beginning, and and then the real estate market just exploded. We're kind of on the other side of that now. What are you seeing today in the market? What do you think? Let's rub your crystal ball and see, 6 months, 12 months out. Where are the opportunities? Where do you think the market's going to go?
So Paul, you've been around long enough too to I believe you probably believe what I'm going to say, but I feel right now opportunity abounds. Our economy is shifting. Some people are deleveraging, and others are taking advantages of the change. Anytime there is change, there is opportunity. If the market's flat, it's kind of tough to make money. But when it's going up or when it's going down,
Mm.
hey, it's time to start making offers and doing deals. And so what I'm seeing are two things. I'm seeing one group of people that are saying, "Oh, prices are too high. We're taking a pause, et cetera, et cetera." And I'm educating them that be advised. So we have an underwriting company in India called Corridor Outsourcing, and they do a report for me every month. And I told them, I said, be advised, we are seeing higher profit margins on our value add deals than I have ever seen since
Huh.
we started this company, ever seen, because they
Wow.
are buying right. And what's driving that, Paul, and it's sad, but it's a reality of capitalism. A lot of people that are commission driven have bought homes that they can now no longer afford.
Mm.
Uh, Very sadly, my wife had a conversation with another wife about a month ago, and like a lot of people, they buy the house based on the down payment and the monthly payment. Well, if their commissions go down, or in other cases, people get laid off, or they take a job where they're not making as much, that has created a lot of distressed sellers. And I hope this doesn't go out too far because I've been telling everybody, look, before you need to be on this before it hits the Wall Street Journal, because just like when the Wall Street Journal started talking about short-term rentals, everybody wanted to do it and it's not what it used to be. So right now is the time to be making offers because there's distressed sellers out there. I made an offer yesterday. Um, it was a property that someone offered 800K on a year ago. I offered 750, and the broker believes that the seller will take the deal.
Mm.
So that's the kind of opportunity that's out there.
Hmm. So yeah, that's so awesome, man. Change creates opportunity. That's right. You don't want to flatline. You want to go on up or down so you can get on one side of that transaction. And what's interesting is that is I'm sensing the same thing too. There's a lot. The more savvy investors are getting really excited, and they're starting to chomp at the bit a little. And I had speaking of the podcast, I had a guy who focuses on this wholesaling that you mentioned. He was on a few weeks ago, and I think he just went live this week. But he talks about that and the stuff that they're seeing. He's out of Phoenix, and
Mhm.
some of those markets that are really cyclical as well, that blew up like a rocket ship, that are adjusting accordingly so and predictably so,
Sure.
are huge opportunities, right?
You're exactly right. And by the way, I listened to Rafael Cortez. Loved that podcast. I
Yeah,
think I got the right guy. I listen
you
to all your
did.
podcasts, but yes,
Thanks.
I loved his story. How he started out kind of like me, you know, at the very bottom, digging ditches
Mm,
and figured it out. He reminded me of me because he seems like he likes to figure things out,
mm.
and I kind of think that's what I'm doing. Whether it's a curse or a gift, my mind is always running. And my partner, I love him to death. He's smart. He's like, Jason, you see shiny objects, you see an economic opportunity,
Uh,
and you're too eager to chase it. And so he's kind of my bumper uh, on that. But sometimes I say, Jason, you're right, but this is too good. We're doing it. So so that was and by the way, Paul, we are starting haven't really announced this, so I guess I'll announce it now since I started. We are starting a wholesale company simply because the timing is right. As
Mm,
you know, timing is almost everything in business. I mean,
yeah.
intelligence is great, but I have met a lot of people that I did not feel were all that intelligent, but they were in the right place at the right time,
Mm,
and did very well. And I feel right now I've got the talent on my team, um, and the resources with some interns that I work with every night, and then most importantly, or just as importantly, the where the market is right now. So we are about to deploy a new company that is based on wholesaling, and what that will do is it will better serve my investors by giving them more deal flow.
mm.
It will create some new income opportunities for some great people that I've had for a long time. And it will also complement a new company that I'm starting. I really can't share much about it due to NDAs and things like that, but I do hope on a future podcast I can share this rather exotic product that's going to really appeal to very active investors.
Nice, nice. That's exciting. Well, exotic product aside, I remember the famous movie The Jerk, where they had that exotic product. You remember that little thing for your eyeglasses that Steve, what's his name, came up with?
Steve Martin. So
Steve Martin. Yeah, yeah,
yes, I heard everybody at school talk about it. It was apparently a funny movie, but I was never allowed to see ours until
yeah.
I left my house. So I will put that on my list of movies to watch.
Oh, I don't think it's worth it. Yeah, yeah. No,
Okay.
it's just kind of a funny thing, but I just thought about that with an exotic product. So no, that's so awesome. But that's totally entrepreneurial, right? That's what you do. You're taking lead and you're turning it into gold. So you have an opportunity, you see it, and you're like, okay, we're going to pursue this now because the time is right.
That's exactly right. Now, and let me elaborate on kind of your last question. A real estate investor's job, in my opinion, is to have credit so that he can pull the trigger and have liquidity so he can pull the trigger. Because unlike Christmas, Easter, Thanksgiving, and your birthday, Paul, deals are not cyclical. They do not, arrive at a certain time. They pop up when you least expect it. And if
Mm,
you are not liquid and you do not have a pre-approval with a lender like Corridor Funding or somebody else, you're shooting yourself in the foot because if you miss a deal, I'm sorry, you lost, you failed. If you are a real estate investor, your job is to buy right. And if you did not have the liquidity and the credit with somebody like us, um, you lost money. That was a W. And just an interesting story. One of my I won't mention his last name, Tom. He um, he was buying. It was an inexpensive house here in San Antonio, maybe like 130,000. This was probably 2 years ago. And I said, Tom, it's been 90 days since I've got you received your current liquidity. Do you mind, please? Will you please send that, and we'll get everything scheduled with title. I knew he would have liquidity, but what was interesting to me is that he had close to $2 million in liquidity that he provided me. And I called Tom and I said, Tom, I'm just curious, why are you buying with my financing if you've got close to $2 million? Just no problem, just for my own
yeah.
edification. And he said, Jason, I never know when a deal is going to come about. Um, and so with the little money that I'm putting into this house, let's just say all in it after interest payments, et cetera, and the down payment, let's call it 20K. If I had 50K in value on that, that's over a 200% return on my capital.
Mhm.
But more importantly than that, this is what I remember so well. More importantly than that 200% return on investment versus maybe a 25 had he paid cash, if I am not liquid when some retiring person wants to sell their tape of rental homes, or there is a multifamily opportunity in one of the areas that I study and know, if I miss out on that because I'm not liquid, I failed. That could be an opportunity of a lifetime. So um, I thought that was very interesting. And I would say that is the perspective of our most successful investors. The opportunity cost of missing out on a deal is just too much to um, think about having to pay interest. And you know what, Paul? Let's most of our loans are originated slightly below 12% right now. In fact, we're even getting back into the 10.9. Um, but that if they're in that for 3, 4, 6 months, that should not impact the profitability. In fact, it should impact it because we lend 100% of the renovation. The only way our loan should impact it is by adding value, which is equity, piggy bank they can borrow from, and achieve a higher return on the actual capital that they invested in that deal.
Yeah, yeah, no, that's wow. What a great way to kind of wind down on Tom and his advice and the success, because that is so true. And you talk about you're in and out of that money in a fairly short period of time, so the annual interest rate is irrelevant. It's the opportunity cost of if you miss the deal because you didn't have your funding in place, then your opportunity cost is infinite, right? I mean, it's the deal you didn't get, and you want to be able to execute fast. You want to have dry powder in your gun, right? So you can pull the trigger at will. And the smart investors, they want to have liquidity, right? I'd rather use your money than my money. I'd rather my money be working somewhere else, so I have it for another
Sure.
opportunity, and it makes me feel good to have money in the bank, right?
Absolutely. Absolutely, it does. It
Yeah,
does, and it quite frankly gives you more security. I mean, if you've got the money in your bank and you're less likely to get into a bind because you paid cash on something. Um, and like I said, we lend 100% of the renovation, which our borrowers really appreciate and works well for us. So yes, we essentially just have two loan products: the value add and the new construction is essentially value add, right? So
yeah.
the interest only, we do them all on a 12-month term. Most of my peer competitors either do a 6-month term, or at month 6 they have what's called an automatic extension, or some of them even start at month 3. And
Mm,
what that auto extension is, Paul, is you don't see it in your interest payment,
yeah.
but at that month where it kicks in, it begins accruing, and usually it's like 33 basis points to
Mm,
40, 50 basis points. So if you go 9 months into that loan and they're charging a 50 basis point auto extension fee, when you get your payoff statement, you're going to see another 1.5% of expense on that property. And I
mhm,
personally do not think that is transparent. So we
mhm.
do not do that.
Yeah.
And I do not loan to own. We have not, I've had to foreclose, I think, on five out of over 2,000 deals. But I'm proud to say 3 of those were either health or life event related, and
Yeah.
only a couple of them were, well, you know,
Everyone makes a mistake or two,
yes.
so no, that's like infinitely zero. I mean, it's just a testimony to the quality of the people you're working with, your team, for vetting everyone and the process. Because I know also you in those times that require your team is involved with the borrower to make sure they're getting over any humps or any challenges they have as can come up from time to time, because because again, win-win-win, right? It's in everyone's best interest to get through maybe a sticky time, like maybe the little COVID when COVID hit. I know it got a little ugly in the beginning, but then you do what you
Yes.
got to do.
That's right. That's right. We did pause for about 30 days in COVID just to kind of figure out what was going on, but we were
Mm,
one of the first to come back. And I believe that's because I have excellent partners, Paul. I'm very relationship oriented, and
mm,
you know that, and you're the same. And I have people every week, every time I go to a conference, they're willing to buy my notes. If I call it paper, please understand, for your audience, I mean notes. But if they buy my paper if they're offering to buy my notes at a better rate than what the groups I've dealt with for years have done, I don't jump around. I'm very relationship oriented. I may go and try to renegotiate,
mm,
but we do not sell just to get the top dollar. We believe, and I have seen through COVID, for example, um, a lot of my peer competitors, when the paper that they were stuck with was marked to market, they were required to
mm,
sell
mm.
several million dollars worth of paper at a discount.
Yeah.
And my partners, I said, look, ladies and gentlemen, it's a life insurance company out of New York. I said, ladies and gentlemen, if you will trust me on this, we will service this paper. I know the borrowers, they will pay, and let's get a few months into this,
Mhm.
and I know we can get par. Well, by August, Paul, we were able to sell that. I was about to say me, but my partner gets credit for this. We sold that paper to Veris for like a 3.5% premium.
Mhm.
So in just a matter of a few months, the market
Mhm.
swung like
Wow.
that. And that's the value of sticking with good people and good partners and not just switching around for a few extra bucks. And what's interesting, Paul, a lot of those companies that were coming out of the woodwork to buy my paper at these wonderful rates are no longer around.
Yeah. Yeah, someone said that's peeing in your pants to keep your butt warm, right? It only works for a little while.
That's good. I've never heard that, but I like it.
Yeah, I have a lot of those that somehow got in my buried in my subconscious. I don't know how, but I'm not proud of that. It's just there and it comes
Well,
out.
I'm glad to know of that temporary measure if I ever get cold, but I'm also glad to know that I've never had to employ it, Paul.
Yeah, that's right. Well, that's because it's very hot in Texas and Mexico and the places that you've lived and spent time. So
That's right.
anyway, well, Jason, this has been a lot of fun, man. We're already at the end. We're actually over time. So let's do this. Tell everyone how they can get up with you guys if they're interested, if they're in your lending area, or if they have an inquiry about it, and if they are or they aren't, they can find out for sure by
Sure.
reaching out to you guys.
Well, thank you for that opportunity, Paul. I really appreciate that. Our website is Corridor Funding, Corridor funding.com. And my personal phone number is 214-274-5210. Anybody interested in getting involved in creating a passive income empire or just investing in multifamily or SFR, which stands for single family residence, please give me a call. We do not look for just to do one dance with somebody. We're looking for people like my team that are goal oriented, ethical, moral, tend their business, and most of them tend to be family people as we are. So if your profile is a good match for us and you're looking for service and value in addition to just financing, I encourage you to give us a call. We will see if we're the right fit for you. And if we are, we'd take you on as a customer and take very good care of you.
Awesome, awesome, and I know you will, Jason. This has been fantastic. I appreciate your time today. It's been a lot of fun too.
It has been fun, Paul. It's always good to see you. I love your podcast. And by the way, that YouTube on your webpage, I think you must have done it probably in September, October of last year. But in re-listening to it, now that time has passed, I want to say one, your analysis was very interesting and intriguing. But now that time has passed, it was also very prescient. You were correct in a lot of the um, hypothesis that you shared on that. So you are a pillar in this business, and I will always call you for advice, and I appreciate that.
I appreciate that, Jason. Awesome. Kind words. Have a wonderful day, man.
Thank you, Paul. Thank you for having me. Thank you, everybody, for listening. Y'all have a great week.